Hi, everybody, and welcome back to EBnet Stream. It's an absolute pleasure today to welcome Gari Dhombo, who is the CEO of GrowthHouse Short-Term Insurance, to discuss with us some of the trends that he is seeing in the short-term insurance market for this year. Gary, welcome to EBnet Stream.
Thank you, Natalie. Thank you for the opportunity.
You're welcome. I think if you could perhaps start, maybe share a little bit about GrowthHouse, and then we can jump into the trends that you're seeing.
Natalie, GrowthHouse is an independent financial services provider. We operate in the financial services space. The area of focus for myself is primarily in the short-term insurance area, where we give clients an opportunity to have cover with essentially the whole market. We cover essentially the whole market, primarily on business insurance as well as personal insurance. We also got what we call corporate and specialty area, which covers the bigger corporate accounts, as well as what we refer to as specialty, which is some special lines of coverage, for example, medical malpractice, professional indemnity, and related type covers. We call that basically specialty covers.
I specifically wanted to ask you that because I think it sets the scene for quite a broad understanding of where the insurance market is and kind of what we're seeing in the short-term insurance market. So perhaps you could outline for me some of those high-level themes that you guys are seeing.
I think what we're seeing to a large extent, we're seeing a real evolution in terms of the way I think risks are currently coming onto the market space and being measured. Natalie, I would specifically talk to what we would call emerging risks. And these are not your conventional risks that we always used to have. We now have new risks that are coming up, and insurers have to keep abreast, both in terms of ensuring that we understand the exposure itself, but also more importantly, that we are able to advise our clients. At GrowthHouse, we, as an independent broker, we pride ourselves in ensuring that we give the best of breed. We give the best of breed in terms of cover, but also we look at the price. But we don't focus just on price, because we believe price can be very misleading. Our point of departure is always that no policy is the same, no risk is the same. So we also treat each one in their unique context and look at it from that point of view. When I talk of emerging risks, for example, cyber risk is an emerging risk, Natalie, in that right now there is a lot of data that we share. There is a lot of cyber liability that could ensue from sharing a third-party data without their authorization. There's legislation that has come on board, for example, POPIA, to try and counter that and ensure that we are also kept honest. But when we talk of cyber liability, what exactly are we talking about? We are talking of businesses being protecting themselves against financial losses caused by cyber incidents. For example, it's data breaches. It's the likes of ransomware attacks. It's the likes of hacking. And what follows there is also business interruption due to cyber attacks. There is theft of customer or employee data, which also is important, as well as cyber extortion. All that combines to give you what we call a cyber liability exposure. As insurers, then we look at how best can you unpack the cyber liability exposure, Natalie. And you unpack it essentially in two areas. There's what we call a first party a cover, and there's third party cover. First party cover talks to the client themselves. Third party talks to their clients. So essentially you're looking at the client and saying what data breaches would they face? What sort of attendant costs comes with it? What sort of cyber extortion could come to the fore, or loss of income in terms of business interruption, the crisis management costs in terms of trying to repair your reputation, etc. All that is covered in a cyber liability policy as a first party risk. The third-party risk then talks to their clients. How best do you protect your client's data? Because if you do not protect your client's data, there could also be regulatory fines, legal costs. You could be sued for actually a breach of a data law in that space. So again, those are essentially the areas that insurers look at: first party and third party in addressing cyber risks. So we have got a number of specialist insurers who looks at those risks. What you look at is potentially what could be the exposure. In other words, how big is the likely exposure? And we also say who needs it. Naturally, in terms of the clients who need it, I think any business that deals with emails, any business that has got or stores customer data, any business that processes payments or operates online. So it's probably everybody. We've probably covered every business. Potentially would have that kind of an exposure. So that's the cyber exposure that we have seen as an emerging risk. Natalie, if I may, I'll move on to what we also consider emerging risks, but they've always been there. And primarily, I'm now looking at weather-related type exposures, which climate change has become a real exposure to a lot of insurers. And the climate risks essentially then, because of the nature of exposure and the magnitude of the exposure, normally there are reinsurers that sit behind insurers. And those reinsurers are the ones that determine the price. They drive the price to the primary insurers. So the control from an insurer perspective sometimes is limited in that the reinsurer dictates to you, because these are catastrophe exposures. They're normally looked at as catastrophe exposures. For example, when you look at the flooding in KZN that happened in 2022, costs were in the region of 17-20 billion, which is quite high, and no single insurer would carry that. They pass that risk on to their reinsurers. And when they do that, the reinsurers then have to reprice their reinsurance programs, which then impacts you and me as the consumers. So for us, it's important that we educate clients in that space. But besides floods, the extreme of floods, which is drought, is also an attendant risk. And drought in itself can also be an exposure which insurers face, particularly in the agricultural space. So the mechanisms to be able to detect potential for floods, or the mechanism to be able to predict the likelihood of some of those catastrophes happening is important. And insurers are also grappling with that, but also ensuring that they try and get always ahead of that to be able to predict that this area is flood prone. So how do we assist our clients and ensure that our clients are not as exposed? That is an important area, particularly for insurers to respond in terms of advanced modeling techniques, etc. But also engaging with other stakeholders, primarily the government, in terms of particularly ensuring that weather risks are kept under check. The other risk, Natalie, that I probably would want to talk to is around the transport exposure, which is also quite a high risk. A high risk in the sense that our roads are under pressure because the rail infrastructure is not coping. And because the rail infrastructure is probably now in a dismantled state, the challenge is a lot of our goods are transported by road. So that alone presents challenges. And how as insurers also try to come into that space to assist. You find, for example, the likes of Discovery, the likes of Auto in General have teamed up to start that pothole brigade, which assists clients, because ultimately then it saves vehicles from accidents and assists motorists on the road, because vehicle insurance is probably the biggest insurance asset that insurers actually insure. And when you look at it, we've got about 12,000 deaths a year. So it's quite huge. You've got the likes of Wallard Insurance who partner with government in running arrival life campaigns. Very important as well.
Sure.
You've got the likes of Outsurance, who also run, for example, the traffic pointsman campaigns. Again, all those coordinated efforts from insurers are meant to reduce not only the level of fatalities, but also the high accident rate in the country. But again, the moment you've got so many trucks on our roads, the infrastructure itself then is under huge pressure to cope. And in the process, then we find ourselves with challenges around roads that are not as well maintained as they probably should be, because some of these goods should be transported by rail. The fourth area that, Natalie, that I thought I should bring to the fore talks to commoditization of insurance. Our point of departure is always that not all policies are the same. And we try and encourage clients not to chase price. The challenge then is when you are presented with two quotations, Natalie, you just tend to gravitate towards the cheaper one, without understanding the exclusions, without understanding the deductibles that actually that particular product would carry. Price becomes your only focus, and consumers may not understand exactly what is and what is not covered. Commoditization cuts out the broker, because what it does is you are essentially removing advice. And when you remove advice in that value chain, you must also just realize the risks that you are also running. Because the advisor is there for a reason, and it doesn't necessarily mean without advice, if you don't get advice, it doesn't necessarily mean you're going to pay more. And there's always a conception that you pay more, but ultimately you pay even more if you don't get the advice. The clients can be underinsured, they can be misinsured. And that risk alone is bigger than not having an advisor in the process. We encourage our clients, we always say one size does not fit all. And for us, that's important. Lack of advice will always lead to high rejection rates. Lack of advice will always lead to legal disputes. If you get advice, Natalie, from an insurance practitioner or a broker, your advantage there is that you now have got a fallback position. If the insurer does not cover you, but the broker did not give you the advice, there is what is called professional indemnity cover, which protects the broker, which protects the advisor. So if the advisor does not give you the necessary advice and you find there are gaps in cover, that advisor is liable. And you can go to that advisor and basically sue that advisor. That's why advisors also have got professional indemnity cover. And it's compulsory. Every advisor carries professional indemnity or professional liability cover. And they carry specifically because they carry an advice risk. So I think those four specific areas for me are critical. And I thought it's important, Natalie, that I bring them to the fore. We are talking climate risk. We are talking the transportation and infrastructure challenges. We are talking commoditization of insurance. And obviously the first one, which I spoke to, which is cyber liability, which covers the various areas that I spoke to.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally, all for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
Before we carry on, and maybe just to give a bit of context to the community who's listening to this, we're not just talking big business insurance. I mean, we're talking Natalie Burrows's, household insurance, my car insurance. And so these are aspects, if I'm hearing you correctly, or trends that, if I'm hearing you correctly, that are affecting me, right? The man in the street.
Absolutely. They affect the men in the street, they affect small businesses, they affect big corporates. The level, the degree may differ, Natalie, but at the end of the day, the impact could just be as high. Data privacy extends to individuals. It
Yes.
extends to small businesses. It extends to bigger businesses. We have seen instances where individuals are sued because they basically did not protect somebody's privacy. That's where data privacy comes in, particularly in the cyberspace. When we talk of potholes, Natalie, they affect me, you, and everyone on the road. Whether you're driving or you're a passenger, you're still impacted. And it's important that insurers also play a role. And this is why I referenced the number of insurers that are participating to try and mitigate the risk. But also it's in their interest, because naturally the road accidents then hopefully can be reduced. So it's important insurers participate. They've got a direct interest in ensuring we do not have potholes on the roads, in ensuring our rail infrastructure does work, in ensuring that clients are given the best advice on how to protect themselves from potential data breaches. So those are all, I think, Natalie, to a large extent, it impacts everybody. And it's important that we're all aware of what those risks are.
And now that we know the trends and we've identified them, and you talk about the insurers being, I want to say, actively involved in almost risk mitigation for the man in the streets, as well as small and medium-sized enterprises and business. How does the insurance market or the insurer pool, how do they mitigate and look forward to kind of prevent or to dampen the risks and the impact of these risks and trends on premiums? And specifically when it comes to something like cyber. I mean, I can just off the top of my head, I'm thinking about, I submit a claim because my geyser bursts,
Sure.
and some bad actor accesses my email, and the proceeds or my premiums or whatever gets paid into the wrong bank account. I mean, what are insurers doing to stay ahead of these trends to mitigate their impact on the household purse?
So the point of departure, Natalie, is always the advice to the insuring public is act as if you are not insured. Risk management becomes quite critical in as a risk intervention and risk mitigating factor. When we say act as if you are not insured, what we're saying is, first, you are the responsible party, and try and ensure that you do not claim. I'll put it in quotes, that you avoid claiming, because claiming in itself results in increased premiums.
Sure.
Insurance is about the fortunes of a few, the fortunes of many being taken care of by the fortunes of the few. We are all pulling risks together and hoping that no one claims. In the process, and then the premiums should come down. If we pull our risks into this pool and we all claim, chances are then the premiums will increase. So at a very basic level, Natalie, we say act as if you are not insured. So drive as carefully as you can. Try and protect your risks as much as you can. Protect your client's data from third-party interventions, etc. The better your risk management processes, the better your premiums, the lower your premiums. Okay. So you turn around and you say, I have protected my business as much as I can. I've protected my home as much as I can. The moment you do that, you are the preferred risk. So naturally, you attract a much lower rate. So how do you reduce your premium? Reduce your premium by improving your risk. go for advanced driving lessons, for example. Prove it to your insurer that's what you've done. Put an alarm system on your vehicle. Claim less. I always turn around and say insurers have got a dim view on high frequency claimers. They will definitely respond if it's, you can insure today, Natalie, in your house for 10 million and it burns down today. It doesn't mean you'll not be able to get insurance. That's
sure.
exactly why you take insurance. But the moment you're going to submit 1,000 Rand claim every week, it's talking to behavior. It's talking to some moral risk. And insurers want to guard against that. So high frequency claimers are normally perceived as a high risk. But severity itself is probably what you really want to be covered for.
Sure.
So that because that may happen and you'll be unfortunate enough to have that big claim that comes through.
Exactly. I mean, insurance is there to protect against the catastrophe or the main event. And so I hear you. I think we've unfortunately run out of time, but I think if we could maybe wrap up with perhaps your views on, I hear what you're saying, protect myself, do the right things, engage in the right behavior, don't drive at night, try not to drive drunk, etc., etc. But
Sure.
the cyber one is an interesting one because I can't protect myself against that, and it seems to be developing so fast. The technology is so rapid that it's difficult to stay ahead of it. So what would you recommend for businesses or for general people like myself?
I think the key issue is it's about data protection. Yes, there are regulations, but how do you ensure you protect your data from third-party interventions, from third-party attacks? That, for me, is the best advice I can give, Natalie. How do you protect your data? So bring in those safeguards to ensure that no one can actually just access your data and abuse your data, because that's really the risk around cyber security.
Don't click on those fishy links, right?
Just don't click on those fishy links.
Gari Dhombo from GrowthHouse Short-Term Insurance, the CEO of GrowthHouse. Thank you so much for spending time with us on EBnet Stream today, and best of luck.
Thank you. Thank you so much, Natalie. Thanks for the opportunity, and I hope this was useful. Thank you.
Keep well, Gary. Cheers.
Cheers, Natalie. Bye.